Jamie Dimon recently said that the United States economy is driving off of a cliff. For those of you who don't know, Jamie Dimon is the CEO of the largest bank in the United States, JP Chase Bank. He gave a talk at the Bipartisan Policy Center where he said that the United States government is spending so much money that it is inflating markets, and markets are loving it today. But eventually, this is going to create distrust in the markets because markets will eventually start to lose faith in the dollar and the United States economy, and it's going to push the United States economy off of a cliff, and it will lead to chaos. Take a listen.
If you look at that 100% of debt to GDP, I think 1935 it's going to be 130%, and it's a hockey stick. So that hockey stick doesn't start yet. We kind of got time, but when it starts, markets around the world, by the way, because foreigners own $7 trillion of U.S. government debt, there will be a rebellion, and that is the worst possible way to do it. It is a cliff. We see the cliff. It's about 10 years out. We're going 60 miles an hour.
It's the most predictable crisis we've ever had.
Exactly.
Now, I've already spent the time going through the entire interview, and I'm going to break it down for you here. But if you want to watch the interview for yourself, I will link it for you down in the description. But one of the things that Jamie Dimon talks about is he compares the economy today to the early 1980s. Because in the early 1980s, the United States was also going through another inflation crisis. And what he said is that in the early 1980s, the United States economy was facing around 12% inflation. But the difference between today's economy and then was that the debt to GDP ratio in the United States, meaning how much money the United States government was borrowing relative to the entire size of our economy, was 35%. What he says is that today we're above 100% debt to GDP, and we should also mention that our peak inflation, reported inflation, was 9.1%. I understand that the inflation definitions have changed a little bit between now and the early 1980s, but the reported peak inflation was 9.1%, but our debt to GDP is over 100% today. And the reason why he says this is such a big deal is because when the United States economy was in this recession in the early 1980s, because we were in a recession in the early 1980s, unemployment was around 10%. There was a lot of economic pain going on because in the early 1980s, when inflation hit 12%, the Federal Reserve Chairman, Paul Volcker, was much more aggressive to bring inflation down. He jacked up interest rates to some of the highest levels we've seen at around 20%, which meant if you wanted to go out and get a mortgage, you were paying close to 20% interest to go out and get a mortgage, not like what we're seeing today. So it was much more aggressive, and this caused unemployment to shoot up, and we were in a recession. But even though the United States economy was in a recession in the early 1980s, what he said is that the government deficit, meaning how much debt the United States government was going into every single year, was about 4 to 5% of GDP during that recession. Remember, the United States government was spending money in order to stimulate the economy to get us out of that recession, and despite that, we were spending 4 to 5% of our GDP on deficit to stimulate the economy. Today we are in a boom economy. The economy is not in a recession. The economy is booming. We have low unemployment, yet the United States government is running a 6.5% deficit relative to GDP to stimulate an already stimulated economy. This is what Jamie Dimon says is creating this big bubble inside of the United States, where the United States economy is printing money, stimulating markets, making people money, which is great today, but eventually we're going to be driving off of a cliff. What he says is the United States economy is driving 60 miles an hour. We know there's a cliff ahead. We don't know exactly how far it is. He says in that video that maybe it's 10 years out, but we're just driving straight towards it, and we're not doing anything to stop it because the United States government keeps spending money, they keep spending money, they keep stimulating, and the Federal Reserve Bank is not being as aggressive as it was before, which sure, in the short term is creating a big boom. People are making money, markets are inflated, which are great, but he says that that party is eventually going to come to an end. Now, this is where I'm going to go a little bit deeper to what he says. I'm going to take an aside here. This is where it's very important for you to understand what's going on and be financially educated. That way you can take care of yourself, your family, and your community no matter what's going on. And just so you know, on February 6th, this year, 2024, I'm hosting a wealth building workshop. It is my first time doing this, where I'm going to be going over, number one, economic changes to expect this year, but number two, also, which is how you can build a financial plan, how you can start building wealth, and how you can start generating cash flow despite what's going on in the economy. This workshop is completely free. It is live. I'm going to host 2 live workshops on February 6th, one in the morning, one in the evening, and I'd love to have you there. It's completely free. We're going to be going over how you can build wealth. It's going to be a lot of fun, and well, you can pick a time that works best for you. So if you'd like to join me for free on this live workshop, I got the link to how you can join me on February 6th down in the description below. The trigger, according to Jamie Dimon, which will will cause chaos in the markets is when markets realize that the United States is spending money on a hockey stick curve. So what he says is that in the early 1980s, we were running a 35% debt to GDP ratio. Today, he says we're a little bit above 100%. But what he says is that in the next 10 years, we're going to be running at around 130 to 135% debt to GDP. And that's when he says that markets around the world, not just in the United States, but markets around the world are going to start to panic. And that's going to create more chaos. And that's where he says that people need to be prepared. And what's interesting is that's where he says that the United States government needs to understand this and make the military stronger to be ready for when that chaos comes. Take a listen.
This is about the security of the world.
Yeah.
We need a stronger military. We need a stronger America. We need it now.
This is where things get a little bit difficult, because the question is now, how do you actually solve this? And the answer might seem pretty simple. Cut back government spending. But that's not so simple to do. And it's not so simple because, number one, no president wants to be that president that is taking away your entitlements. No president wants to be the one that deals with that sort of economic consequence. And number two is, who do you take the money from? Because now when we talk about the government spending less money during a time where everyone is so addicted and reliant to free government money, who do you take the money from? Are you going to take it away from people who are relying on Medicare or Medicaid? Are you going to take it away from people who are relying on Social Security? Are you going to take it away from the firefighters or police officers? Are you going to stop investing in the infrastructure? Are you going to stop investing in the military? Are you going to stop investing in interest payments and default on your debt? Where is the United States government going to stop spending money? And anywhere it stops spending money, there's going to be pain. And the problem is, it's very difficult for an administration in charge. I don't care if you're a Republican or Democrat. It's very hard for an administration in charge to want to cut back. Now, sure, Democrats might want to cut more money on military expenses versus other entitlements, versus Republicans might want to cut back on certain entitlements versus the military. There's differences on how some political parties want to cut expenses. But in general, no party wants to cut expenses for people, because then that looks bad on the party. Because then if people don't have those money coming in, that means people lose jobs, because yes, there are people relying on the government for jobs. There's people relying on the government for money. Not to mention the fact that government spending is one of the leading source of stimulus for the economy. I mean, when the government spends money, that gives people an income to go out and buy a home. It gives people an income to go out and buy a car. It gives people an income to go out and throw money into the stock market to help stimulate the economy. And so now when we think about when you are a president in office and you have 4 years in office, you want to see the stock market rally. You want to see unemployment go down, because that helps you get reelected and it helps you look like a good president. But the issue is, if you keep printing money and spending money, that has consequences. It has long-term consequences. One of the things that I kept saying during the pandemic is that the most expensive kind of money is free money. Free money is nice because if you get free money from the government, whether it's in the form of an unemployment check or a stimulus check or a PPP loan if you're a business, the problem with this is there's a cost to that. See, when the government spends money, there's only one source of income that the government has, and it's through taxpayers, through tax dollars, people like you and me. So when you and I give the government money in the form of taxes, that's the money that the government has to spend. But when the government spends money that they don't have, somebody has to bear that bill, and that person is everybody, especially the people that don't understand money, because then what happens is when the government spends money that they don't have, the first thing that happens is the hidden tax, inflation. See, when the government raises taxes, say on rich people to finance a new road, everybody knows where the money is coming from. They raised this $100 million from these people to get this money to build a road. But when they can't approve that tax bill, but they still spend the $100 million, then who pays for it? Well, there's everybody through this hidden tax, and especially those who are not financially educated, because when the government spends money they don't have, this creates inflation. Who does inflation benefit? Well, it disproportionately benefits the financially educated, while disproportionately hurting the financially uneducated, because inflation hurts consumers. If you go out and you spend money in the grocery store, inflation means you got to spend more money. If you go out and buy an airline ticket, inflation means you got to pay more money. So inflation hurts people who spend money. Everybody spends money. Rich people, poor people, middle class people, everybody's a consumer. So inflation hurts everybody, but it benefits those who are financially educated, because inflation also means that the investors in the construction company make more money. It means that the people who own the assets see the valuation of the assets rise. And the only people who understand this are the people who are financially educated, who put their money to work, who are investors. These are the financially educated, so they benefit from inflation. That's just the first cost. But then you have the second cost, which is the government's got to pay the money back, plus interest. Because when the government spends money they don't have, they have to borrow this money. They might borrow this money from the Federal Reserve Bank. They might borrow this money from investors or other countries. The government borrows this money and then they have to pay it back plus interest. Well, how do they pay this money back? They got to generate tax dollars. So now, maybe they didn't tax you today, but they're going to tax you in the future. They might tax your kids in the future in order to pay back that money plus interest. If you go to the Gucci store and you got $3,000 in your pocket and you go out and buy a belt or a wallet or a purse, well, that money is coming out of your pocket today. But if you go and finance it on your credit card, you don't got to pay that money today. Maybe you pay it off in installments, but you're going to pay the $3,000 back plus interest. Now, sure, maybe you pay that credit card with a Visa or another American Express, so you put your credit card on another credit card and you keep delaying the inevitable, but eventually you're going to have to pay it back. And this is what the United States government is doing. We've been spending so much money that now we're going to have to start paying this money back plus interest. And the reason why this is so significant is because interest rates have gone up so significantly in the last couple of years. Now remember, during the pandemic days, the United States government was spending a lot of money that they didn't have to fund the stimulus programs, to fund the bailouts, to fund all the money printing that they were doing. Well, during that time, the interest rates were so low. So the payments on this debt was super cheap for the United States government. But just like how most corporate debt is not a 30-year fixed rate mortgage, most of our national debt is not a 30-year fixed rate mortgage either, which means that in the coming 6, 12, and 18, 24 months, the United States government is going to see a wave of new debt readjustments, which means the payments on a lot of this debt is going to start getting a lot more expensive for the United States government, assuming the interest rates continue to stay high. And even if interest rates get cut in 2024, well, interest rates are still much higher than where they were before, which means that the expenses for the United States government are going to get higher. In fact, take a look at this chart. This is a chart showing some of the largest expenses for the United States government, and on the bottom you can see that red line, which is the net interest expense. This is the amount of money that the United States government has to pay in interest. And this interest expense is the fastest growing expense for the United States government. And you can see this dotted line, this is the projections in the future. You can see that in the next number of decades, interest payments are expected to not only exceed the military budget, to not only exceed the Medicare budget, but to also exceed the Social Security budget and to be one of the largest expenses, if not the largest expense on the United States government's books, which means the largest expense is not taking care of you, it's paying back previous expenses. Again, this is where Jamie Dimon says it is one of the most predictable crises that we can see, is because we see that once we hit this hockey stick curve of the government keeps spending more money relative to our GDP, eventually markets and investors around the world are going to panic, and that's going to create chaos. Now let's take a look at a debt to GDP chart. This is a chart from long-term trends showing the federal debt to GDP over the last 50 years. And what you can see is that 50 years ago, the federal debt to GDP ratio was around the 30% mark according to these numbers. And today we're way over the 100% mark. And this is where Jamie Dimon says is if we continue at this route for the next 10 years, we're going to be passing the 130% federal debt to GDP ratio. Now, of course, he might be using some different ratios and numbers, but where he says is that's going to create more of the hockey stick curve of now the federal debt to GDP ratio going straight up, and that's going to create more panic in the markets. This is why, again, the most expensive kind of money is free money. Money printing today creates a lot of stimulus, it creates a lot of boom, which is good, but it has consequences. Now, of course, the United States is the best place to be investing your money today. And we've seen that throughout history, no matter what happens in the United States economy, we go through booms, we go through busts, but the investors who invest for the long term get all the benefits. That is still the case. However, there are risks to the markets because of these issues, and this is where now you want to understand the things that are going on. That way you can prepare, but also be ready to capitalize on opportunities, because, well, anytime you see chaos, anytime you see fear, anytime you see panic, all these things create opportunities for those who are financially educated and prepared. And your goal is to be a financially educated investor, not a panicky or worrisome investor, because that means you get to take all the benefits instead of panicking while everybody else is freaking out. Let's start by understanding why the Treasury Secretary is saying that Americans have more money today than really ever before. Let's dive in. According to the Treasury Secretary's report, in 2023, the median American worker can afford the same goods and services they did in 2019 and still have an extra